Well, I think initially a bit surprised, but it's a really pragmatic move by Ford and GM. I mean, listen, the build out of the charging infrastructure is not keeping pace with the number of introductions that these companies are bringing products into the marketplace and ramping up their production. So it was a pretty pragmatic move. And the bottom line, I think, Andrew, is that what Ford and GM get out of this is not just an increased number of chargers, but the dependability of them, because the current CCS is not so dependable. So it's about the consumer experience.
Buy Tesla shares. That's what British multinational universal bank Barclays said as they see a 30% rally in the clear leader of the electric transition. In April, Barclays reported that global electric vehicle penetration reached 14%, slightly outpacing last year's EV penetration of 13%. Despite the rise, it fell short of the heightened levels observed in the fourth quarter of 2022. By May, the industry showed promising signs of a substantial month-over-month increase in EV penetration, indicating a positive trajectory. In light of this, although Tesla's market share remains stable, the actual strength might not be as robust as the price reductions people would have expected. Now, while the U.S. electric vehicle market continues to make progress, the cautious approach taken by GM and Ford in scaling up production could impede any rapid acceleration. China, on the other hand, maintained its position as the global leader in EV penetration, with a rate of 30.9% in April, marking an increase of approximately 50 bps month-over-month. The United States, too, experienced a positive month-over-month growth in EV penetration, gaining around 40 bps and reaching 8.2%. However, despite Europe's significant lead over the US with a penetration rate of 16.5%, it hindered the overall global improvement in EV penetration in April, with a decrease of about 240 bps month-over-month. That said, China continues to dominate the global EV share, accounting for 55% of EV unit sales volume year-to-date in 2023, with Europe at 25% and the US at 12%. In April, Barclays analysts foresee May EV penetration rates tracking to a solid month-over-month uptick, likely bringing May's global EV penetration into the 14.5 to 15% range. Early data from the US indicates an 8.4% EV penetration rate in May, in line with April and the average result of 2023 to date. In April, Tesla saw a global BEV market share of 17%, a considerable step back from the robust 25% share it posted in March. Regionally, Tesla saw a 61% April BEV share in the US, holding steady versus recent months and effectively flat year-over-year. Europe and China Tesla saw a BEV market share of 10.5% and 10.1% respectively, although the April 2022 COVID shutdown-driven volume challenges for Tesla in Shanghai make year-over-year comps irrelevant. Both GM and Ford have spoken of plans for significant boost to BEV production in 2023, with GM more sharply ramping up its Ultium vehicles and Ford seeing increased output from its updated F-150 Lightning and Mustang Mach-E production lines. However, there's a sense that the ramp-up of legacy OEM BEV production is reminiscent of the chip shortage, with delays and slow progress. Consequently, some investors are starting to question whether OEMs will intentionally slow down their BEV ramps due to ongoing challenges in achieving profitable BEV operations. Analyst wrote in a note, "Though we expect BEV uptake in the US to continue, we note it likely won't occur as rapidly as some might have expected when the initial IRA credits were announced, given a number of remaining headwinds such as consumer interest, charging infrastructure, and profitability challenges." Still, Barclays said that it's a good time to buy Tesla shares as they see a 30% rally in the clear leader of the electric transition. During the firm's multifaceted call a few months back, Barclays shared extensive coverage on several automakers. There, Tesla stood out as the king of the road for Barclays. Analyst Dan Levy initiated coverage on the Elon Musk-led company with an overweight rating and set a price target of $275, citing its favorable position in the firm's two-clock framework. We believe that Tesla's clear lead in both the global EV transition and the emergence of the software-defined vehicle, as well as positive trajectory on volume, should lead to outperformance for the stock, Levy wrote in a note to clients. Levy added that Tesla's strong financial position puts it in a favorable position on one clock. On the other hand, it's leading the EV transition according to the analyst. Despite the questions which emerged around Tesla amid its solid underperformance through the latter part of 2022, we believe Tesla remains the clear leader, the Barclays analyst said. Tesla doesn't have to deal with the same cost that legacy automakers making the transition to EVs face. In turn, the company has a significant margin lead. Levy also acknowledged near-term questions surrounding further price cuts and margin normalization that may continue to pressure the stock. He noted that with the stock up more than 70% to start the year, some of the short-term rally was likely over, especially if the Fed continues to raise rates. That said, strong underlying fundamentals combined with a valuation that appears far more reasonable than historical levels provides an attractive opportunity, Levy said. The Barclays analyst also initiated Rivian Automotive with an overweight rating and announced a price target of $28, noting the company was well-positioned to take share in the North American EV market. Although Rivian faced an uphill battle ahead in figuring out how to ramp capacity and navigate the road to profitability, Levy saw Rivian parked in the sweet spot of two key automotive megatrends: electrification and software-defined vehicles. We are hard-pressed to see any company in the auto landscape as the next Tesla, as Tesla has been quite unique in its accomplishments. That said, if we were to identify any of the startup EV automakers as the closest to Tesla, we believe it would be Rivian, Levy said. While Rivian may be considered the top EV maker next to Tesla, the Barclays analyst initiated Ford Motor and General Motors with equal weight ratings, with a 13% price target on the former and a 46% target on the latter. This is in light of the earlier mentioned challenges legacy automakers face. Although Tesla is set up well to gobble up market share, Barclays analyst Dan Levy questions how a key strategic choice will play out. Levy is intrigued by the issue of model concentration at Tesla, as the car maker has a far more limited array of configurations compared with its industry rivals. We appreciate that Tesla has embodied the global auto push to simplification and complexity reduction, he wrote in a recent note to clients. Yet, with Tesla increasingly facing demand constraints and with price cuts, discounts required to clear more volume, it begs the question whether Tesla is running into an issue with excess model concentration. For illustration, Levy notes that Tesla has about 180 different trim configurations for its Model 3, while the BMW 3 Series has roughly 195,000 by his estimates. Granted, Tesla has had success with its strategy thus far, as its Model Y was the world's best-selling car for the first quarter, according to one list. Tesla's path to volume gains has been a contrast, Levy wrote. Not only do Tesla's two primary models, Model 3 and Y, hold significant share, but we'd also argue that part of Tesla's margin lead over other OEMs reflects a very limited set of trim levels given significant scale benefits. But while Levy sees room for Tesla to rack up further gains in market share, he also deems that the path to share gains is getting harder, as the company faces demand challenges and has had to cut prices this year. Levy explored whether cars are like Apple Inc.'s iPhones in that model configurations become less important because customers have the opportunity to customize their experience through software. He sees several cases to be made for the parallel, though he's still not sold. Not only are different vehicle types required for different use cases, but vehicles can also be an expression of one's taste, styles, and preferences, he wrote. Simply, while most people don't mind that many others around them may have the same iPhone or Android, most people don't want the same car as others. Meanwhile, Tesla and legacy automaker Ford shocked Wall Street by announcing a partnership that would let Ford customers plug into Tesla's supercharger network. Competitors rarely work together in the business world, so this came as a shock, a pleasant surprise, that is. The announcement came from a recent Twitter Spaces event that Ford CEO Jim Farley participated in with Musk to discuss the electric vehicle industry. The partnership should make Ford's customers happy, but Tesla's shareholders could be the winners. This recent development could eventually create a profitable revenue stream that could pad Tesla's cash box. Pulling non-Tesla drivers through its charging network is an excellent opportunity to bring profitable revenue to Tesla. The company has already invested the capital in building its charging network, so incremental payments from non-Tesla vehicles should mostly fall straight to its bottom line. For now, it's not yet known what Ford owners will pay to use Tesla's network, but there are some clues. Tesla charges by kilowatt hour, and non-Tesla users pay a premium compared to Tesla owners. Tesla offers a monthly subscription for $12.99 to reduce the kilowatt-hour rate to that of Tesla owners, which might indicate the ballpark that Ford users will end up paying. Right now, paid supercharging revenue is a tiny part of Tesla's business, lumped into services and others in its financials. That revenue bucket was just $1.8 billion of its total $23 billion in the first quarter. Investors shouldn't expect a short-term noticeable impact of deals like Ford's partnership, but that could change. EVs are still just 1.5% of the global fleet, and service revenue from sources like charging could grow into a meaningful category over the coming years. That said, Tesla remains a stock that investors should track closely. Subscribe for more.